That 0.8% management fee isn't just a number. It's stealing $150,000 from your retirement nest egg over the next 2 decades, while you're staring at a dashboard showing steady growth, invisible expense ratios, and front loaded commissions are quietly cannibalizing your principal balance every single day. You aren't just losing potential gains, you are being systematically drained by your own broker. Here is how to expose the hidden fees lurking in your portfolio. And the third method I have for you today. It is completely invisible to most retail investors, yet it can cost you tens of thousands of dollars over a lifetime. So grab a cup of water, make yourself comfortable, and let us get into the numbers. Imagine you invest $10,000 into a standard mutual fund. You look at the expense ratio and see it is 0.8%. That sounds small, right? Like less than a penny on the dollar. But that number is a complete lie. In 2020, a study from the University of California at Berkeley analyzed thousands of funds and found that the total cost of ownership is often double or triple what is printed on the prospectus. These extra costs, often called portfolio turnover costs, are hidden deep within the trade executions of the fund. Every time the fund manager buys or sells a stock, you pay the brokerage commission, the bid ask spread, and the market impact cost. These are not listed on your statement. They are simply subtracted from the fund's total value before you ever see your return. Here is your first win. Stop looking for low expense ratios and start looking for low turnover ratios. You can find this data on any financial screening tool like Morningstar or Yahoo Finance. If a fund has a turnover ratio of 100%, it means they are swapping out their entire portfolio every single year. Think about the transaction costs associated with that kind of activity. My friend Marcus learned this the hard way with his retirement portfolio. He was in a fancy actively managed fund that promised to beat the market, but its turnover was 300%. Over 5 years, his fund returned roughly 6%, while the market returned 9%. That 3% gap compounded over 20 years resulted in a loss of over $40,000. He could have bought a car with that money. He just didn't see the leak. Now let us level up. Even if you pick a fund with low turnover, you might still be paying the hidden tax of tax inefficiency. This is the second way your money is being bled dry. When a fund manager sells a stock for a profit, they generate a capital gain. They distribute that gain to you, the shareholder, at the end of the year. You then have to pay taxes on that gain, even if you never sold a single share of the fund yourself. It is a phantom tax bill. You are essentially paying for the success of a manager who is trading in and out of positions you never asked them to trade. In a taxable account, this can shave off 1 to 2% of your total growth every single year. That might sound like a minor annoyance until you realize that over 30 years, you are losing nearly a quarter of your potential wealth to Uncle Sam because of someone else's trading decisions. If you are finding this helpful, hit subscribe. I drop videos like this every week to help you keep more of your hard-earned money. If this is clicking for you, a quick subscribe helps me keep making these, and you will not miss the final piece of the puzzle. Because honestly, the third method is the one that really keeps me up at night. Okay, remember how I said the best one was coming? This is the one I have been saving for you. It is the cost of cash drag and uninvested dividends. Many investors leave their dividends in a settlement account or a sweep account. You might think you are being safe, but while that money sits there, it is not earning anything. It is actually losing value to inflation. And those settlement accounts, banks often pay you a miserable interest rate of 0.01%, while they lend that same money out for 5% or more. That is the ultimate hidden fee. The opportunity cost of keeping cash on the sidelines is often the single largest expense an investor faces. In a report from Vanguard, researchers found that investors who systematically reinvested dividends outperformed those who let them sit in cash by over 1.5% annually. That is massive. That is the difference between retiring at 60 or working until 70. Here is exactly what you need to do. First, ensure your brokerage account has automatic dividend reinvestment turned on. Most people leave it off by default. It takes 2 clicks. Go into your settings, look for dividend reinvestment, and toggle that switch to on for every security you own. Second, check your cash sweep options. If you have a large amount of cash that you need for a near-term goal, move it into a high-yield savings account or a money market fund that tracks the effective federal funds rate. Do not leave it in a generic sweep account where the bank keeps the spread. You are subsidizing their business model with your own savings. Once you see it this way, you cannot unsee it. It is not just about picking the right stocks. It is about plugging the leaks. So there you go. 3 real ways to save thousands of dollars, and the last one alone could change your entire financial picture. We covered the hidden turnover costs that eat your returns, the phantom tax bills from active management, and the massive opportunity cost of uninvested cash. You are no longer just an investor. You are a guardian of your own wealth. If you got value from this, share it with someone who needs to hear it and subscribe so you do not miss the next one. I am working on a breakdown of how to audit your entire portfolio for these hidden costs in less than 10 minutes. It is going to be a game changer. Thanks for watching, and I will see you in the next one. Think about where that money is sitting tonight. Is it working for you or is it working for the bank? It is your call. Go make those changes. You have got this.